Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 261. Yes, government's still shut down. We're getting limited data that comes in because of that. But we do have some interesting facts that have coming out of the Mortgage Bankers Association conference that just took place. And lots of it has to do with the mortgage data and what the market holds for 2026. That and more in this episode of What's Your One More. So welcome back to the show. So coming out of the MBA conference, and for those listening that may not be aware of that, Mortgage Banker Association conference, they usually do this at the end of the year as a production of going into next year, meaning like, hey, what does this look like? Trends you're seeing, concerns, addresses new technology. I'll touch on that here in a minute. But, you know, there was a resounding enthusiasm coming out of this. And I think the resounding enthusiasm was in regards to the data that came out recently in the mortgages. Now, with the government being shut down, we lose a little bit of data sets, but this in particular is available publicly. And as we kind of go through it here, there's a couple things to kind of talk about. You know, I get these data sets and it cracks me up because as I go through them, there's like this button that says AI summary. And, you know, I'm going to go on a rant here for just a second. But, you know, the thing about AI that drives me nuts is, you know, at the heart of it, it stands for artificial intelligence. Like artificial being fake, being not real, not original. Like, I just blow my mind like, oh, do you want fake intelligence? Do you want a not real intelligence? Choose this. And then the whole chat GPT thing, like, you know, I love it when people think they've discovered like this newfound, you know, Bitcoin or gold when they're like, oh, let me be your coach. I have a chat GPT coaching platform. Just click on this. And I'm like, really? Like, dude, anyone could get that script. And by the way, the more you feed artificial intelligence, the more you're feeding your extinction. It's, you know, it's the craziest thing I've ever seen. It's like, oh, feed a system that wants to put you out of business. Keep pumping something into a fake system that can put you out. And I love it how people think they, you know, the Columbus, you know, of the worlds. Oh, ChatGPT, I got AI summary. Sorry, I went on a rant there. I kind of get lost in that because it drives me nuts. Automation's a different story, though. I did want to say that. Automation, different story, right? I think automating things that improve user experience and improve efficiencies of the individuals doing the job, hey, that's great. AI, fake intelligence, man, maybe we should call that FI from now on, you know. FI, like fake intelligence, right? Could you imagine if your kids had fake intelligence? You'd be enthusiastic about that. Hey, man, I'm going to school because I'm going to be fake intelligence. Now, don't get me wrong, people make money off of AI, and I get it, and it's the newest, latest, and greatest thing. It's going to fizzle out. Studies show right now most people don't even want to do anything with AI from a consumer perspective. They'd rather have person-to-person. It's a matter of time till that phases out. Automations, again, that is something that's real. Automation is real because automation improves efficiencies. It doesn't eliminate jobs. It improves and strengthens the job force that's out there. AI ruins it, probably because it's fake intelligence, as I continue to say. I can go on these rants for a long time here. My producer uses AI, and he's laughing at me over here, but it's fake intelligence, right? I mean, anything it is just fake. Artificial. Substitute of real. Fake intelligence. Okay, I'll stop with this. So let's get into the mortgage data here. Not using an AI summary. So here's what I love about this. There's some recent surprises in this as to why this data is going to be bigger and better as far as production in 26 compared to 25, meaning more volume in the form of more loan transactions, more buyers to the market, and more people maybe selling their home, disposing of their home. That's right. That's the word, disposing. I'll explain that here in a minute. And then maybe investors not getting the return on investment as expected on the monthly payment. So let's talk a little bit about that. How could that be happening? Well, I think the gap between expensive and cheap mortgages has grown deeper than it has been over the last 3 years. Now, we've talked about the lock-in effect. I'll touch on that briefly again. I continue to feel like I'm giving a weekly update on that, but it's changing, and the landscape's changing significantly. I mentioned that in the last show. I'm going to show you the data that just came out on that. We kind of had an indication that was coming, a foreshadow, if you may, and it popped up in the data sets here. But this is interesting. So this gap, this wedge, I'm going to put a graph on our YouTube channel. If you're listening on Apple or Spotify, we appreciate that. Jump on this YouTube channel at What's Your One More with #1. Subscribe. Hit the like button there. Comments are always welcomed and great. We try to review them the best we can. But on here, here's something that's interesting. So when I look at this, there is nearly 20% of all mortgages now in the United States have greater than a 6% interest rate. Now, we weren't just a year ago before that was less than 10%. Now we're at 20%. So what does that tell us, right? Well, it does tell us that still the bulk of the mortgages in the United States are below that 5% and below, right? About 52% of that. But The other 48% are now above that, and 20% of that being higher than 6. And I think after 3 years of like high interest rates in the United States, this mortgage landscape's changed, and the implications of how we should look at the housing market in 26 have changed because of that as well. And here's some interesting developments under the way. So expensive mortgage holders behave differently than lower rate mortgage holders. What do I mean by that? Well, if you're an expensive rate mortgage holder, let's say 6 and above, right? I like expensive. Let's say 6.5 above, right? Because I think low sixes gets the job done right now. But let's say 6.5 and above is defined as expensive for the duration of this podcast, right? For the purpose of this show. Those individuals are less likely to be a hoarder of a property, meaning they're not holding on to that 2.5, 275, saying, I'm not going to let it go unless I get this exuberant price point that I want. They're willing to say, oh, man, I'll trade up. I got a 6.5. I'll go get a 6.25. Because we're seeing these rates now come down to that level where these 6.5s and above, as we like to call in the money pipeline, right? There's some industry lingo for you. In the money pipeline. That's behind the scenes. We talk about that as a secondary market. That's something we say, ooh, these deals can refinance at any moment. They are technically, quote unquote, in the money. So these in the money pipeline deals, they are literally saying, I can trade up or trade down with a 6.5 and get a lower rate. I can refinance, keep the home that I got, or I could list this property, sell it, and go get another property. We're seeing that happen. They're less likely to hold on to that. The other thing we see with that is investors that may have got that rate, because we know that investors are targeted at a higher rate because it's considered a more risky loan, right? It always has the LLPAs attached to it, the loan level price adjustments from the agencies of Fannie and Freddie. But we also know about 18 to 24 months ago, Fannie and Freddie kind of looked down on investors, right? And second homes, because they said, we don't want to be the mecca of where all these homes come. We don't want to be known as a machine that fuels people to have multiple homes. We are here for the American dream. We want primary residences for the most part. So therefore, we're going to punish in the form of pricing second and investment properties. So then created this need in the private sector. And that private sector is normally referred to as a non-qualified mortgage, non-QM for those in the business is what they call it. And it kind of derived with these DSCR loans, right? And we know those are debt service coverage loans. We hear those all the time on the internet and on TikTok and all other social medias. People are talking about DSCR loans and how to do it with just rent rolls and no income, and bank statement loans derived from that. And the list goes on and on and on. Well, those have higher rates than 6.5. Like those are way in the money rates, right? Some of those are in the upper sevens, right? Well, now those individuals are evaluating, is my payment cash flowing? Or can I refinance and get a lower payment rate now with some more defined income than maybe just these DSCR loans? Or the DSCR loans, here's something, those things are way down now in the form of pricing because the mortgage market has changed accordingly, being way down in rate, so they could refinance. There's multiple options there, but we're also seeing those investors saying, rents are deteriorating in some markets. More importantly, maybe I overshot what I thought I could get a rent payment on this, or that I'm going to have some vacancy issues. So they're selling the property, right? So we're seeing when they sell the property, another transaction taking place. We're starting to see implications of that. And then the final one is this. I talk about this. I know I'm beating the drum here, but the labor market is not what it was 2 years ago. I mean, you could argue it's not what it was 6 months ago. We could argue maybe it was not what it was 90 days ago, but it's slowly deteriorating. It's not getting better. And we've seen the signs of that. And typically, this is also showing up in the mortgage market, because if people start to lose their jobs, they're going to let their house go, or they're going to downsize. And so we're starting to see that happen as well. And those three components are really the difference we're seeing in 26 in comparison to what we saw in 21, 22, 23, and 24, and even parts of 25. Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Originator. And what they are doing is they are taking real estate agents and they're taking loan officers, and for the first time in history, they're putting them together under one umbrella. They're actually taking two industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this. You're not just an agent anymore. You're a full service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com. The second thing that's interesting in this that we're starting to see is that just in general, as a public, we're paying off our mortgages very quickly. And again, I go back to this difference of the haves and the have-nots in the form of low interest rates and high interest rates. That's what I mean. I don't mean like income. I'm saying like the haves of low interest rates and the have-nots of low interest rates, right? There's a vast difference, and that difference is also showing up in the form of how fast people are paying off their mortgages. And if you look at the current loan to value for outstanding mortgages in the United States, listen to this, 44%. That means I just want to back up on that. That is just a staggering stat. Like in my 20 plus years of being in the industry, and I could probably go back 50 years, you're not going to see this, that we are building equity at a quicker rate. Now you could argue, you could say, hey, Quinton, well, you've been talking about for a while that the prices are continuing to go up. They're not coming down. That's right. That's adding to it. But the other component of this is that people are paying their mortgages down faster than they have before. A component of that would be 52% that I talked about earlier. They have those interest rates below 5%. Well, if they're paying down the interest quicker, thus attacking the principal faster. With those lower interest rates, that can happen. You can add a little extra to their payment. But what's happened is that it's creating a huge pile of wealth here. And when we take a look at it, that means that 44% low, basically average loan to value. That means there's on average, if you think about this, 55% plus of equity in every home in America on average. Now, I know there's different in different areas and everybody has their own thing, but this is just mind-boggling me. And remember, we talk about this. There's 40% of homes in America. I'm talking about homes now, not mortgages. They don't even have a mortgage. So that is incredible. That's an all-time high as well. So we have a lot of equity here. This adds to the, how can I say it? This adds to the notion of why we're not going to have this real estate doom and gloom collapse. This just further strengthens those podcasts we did about all the people online that sound like idiots when they're talking about housing crash. And, for 13 years, they've been preaching it. For 13 years, they've been consistently wrong. This also adds to the fact that, like, if you're in that younger Gen X, Gen Z, a millennial generation, like, and you're sitting on the sidelines going, hey, I'm waiting for this crash. I'm going to wait for the homes to come down. That's what I'm going to buy. This equity position that I'm talking about, this graph that we have on our YouTube channel, what's your one more with number one, you'll quickly see that the people have room to take hits if there was a hit. Let's say we had a 20% hit. On average, that would put the current loan to value in America at 64%. We had a 20% equity drop. We'd still be at 64% loan to value. So people aren't underwater. These housing crashes that people want to see happen, you have to be underwater for the crash to happen. You can't have equity for the crash to happen. And this essentially reiterates what we've been saying for years on this show. It's absolutely mind-boggling. And equity gains just aren't happening in the housing market. Look at the stock market, all-time highs. Look at the crypto market, all-time highs. It is a equity euphoria taking place right now. And if you want to see that, you can go to any index and take a look at that. But what's interesting is index, I challenge you to take a look. Look at that fear and greed index right now. I'll leave that for another show, but that's pretty interesting considering that's at an all-time high in one particular sector of that particular index there. And then last but not least, I told you I'd come back to this, but we kind of have a new perspective on the lock-in effect. And I think let's back up to what the original perspective is. The original perspective on the lock-in effect was that, hey, all of these loans, all of these new mortgages, refinances that were created during 2020 and 2021 got such a low rate, somewhere between 2 and 4%, that how on earth are people going to shed those rates? How are they going to get rid of those and go buy a new home when they have this payment and this rate they're comfortably locked into that it's going to be a stagnant housing market? And that did happen for some time. But like all things, needs and wants start to take effect. People grow out of their house. New household formations are created. Things happen. I mean, divorces, the list goes on, new births. I mean, you outgrow your house, you need more room. I mean, things happen. Debt consolidation, it all happens. So swapping those interest rates only took a matter of time. And we did suggest that it would happen down the road. I think the thing that's eye-popping here is just how much has switched here. And what I mean for that is swapping a 3% mortgage for a 6.5% mortgage is a difference between, thousands of dollars, right? But people say, well, if I can save money, because we're all payment shoppers at some point, if I can save money on a debt consolidation, swapping that rate's not so much of an issue, right? Because you went from sitting around the dinner table talking about, I got 2%. What'd you go? I got 2.25%. How'd you get 2.25%? Everybody wanted the lowest rate. To now, that's not really a topic of conversation at the dinner table because knowing that you can get rid of that rate, even though you may not be the lowest rate in the room or you might not be the lowest rate on the block, you're saving thousands of dollars a month. And I think that that's the real win there that people are starting to take a look at. It took time for that to come in. And, after 3 years, the average rate on all outstanding mortgages has actually gone up in the United States from 3.8 to 4.4. And so we're seeing that rise start to happen because, 20% of all mortgages are over 6% in America. That'll start to skew that number and make it move there. And I think the final thing I'll leave you with is this. The ironic thing about the lock-in phenomenon, the ironic thing is I think we all thought the cure, including myself, was that, hey, rates have to come down for that unlock effect to take place. And we even said things like, hey, the low five or upper fives is the new 4 or the new 3s, right? The upper fives is the new 3s. And I think everybody, I wasn't just the only one. I can honestly point to thousands of other people that felt the same way. But the ironic thing is this. I think what none of us really thought is that the cure wasn't lower rates. The cure was higher rates. And I think that sounds crazy, but the cure is higher rate because the housing market kind of fell in this lull over the last 3 years. But meanwhile, like the United States homeownership has been in incredible shape. Equity positions we just spoke about, all-time wealth at highs. So over time, the phenomenon slowly evened out, and people said, well, I've got equity. I can trade it in. I can debt consolidate. I can trade this equity to go buy another larger home. Even though the rate's higher, I can still keep the payment in line with my down payment. All these things started to work themselves out, which implies home sales growth in 2026. And I believe the final thing I'll leave with is they're anticipating, they being the MBA, is anticipating 15% uptick in business in 2026 from 2025. That's a resounding number because that number was adjusted from a single digit to a pretty large double digit for 2026. And that's a big win for all of us in the business. It's also the sign of the consumer starting to come back from the pent-up demand. And we talk about that all the time here. I was sitting down with a group of agents. It wasn't maybe 2 weeks ago, and we were talking about all of the new listings coming to market, right? And the ironic thing about that I think was missed in the room wasn't the fact that new listings were coming to the market and that it could be a win, could be a negative thing, depending on how you look at it, is that every person that lists their home traditionally becomes a new buyer. And the person listing that home is not going to list that home without further approval or knowledge that they can go buy another home and that they have the bandwidth to do it and that they're quote unquote pre-approved. That's your pent-up demand. That pent-up demand, all those new listings you see are new buyers wanting to come to the market. And there's your pent-up demand and sign of it on the way. 2026 is showing signs of a really large pent-up demand and excitement in the market. And I'm pretty excited about it because I know what it lends to for us in 2026. So guys, if you like what you're hearing, please share this podcast. Listen to us on Apple, listen to us on Spotify, give us a couple reviews, 5 stars there if you can. But also, if you want to see these charts, go to our YouTube channel, What's Your One More with the number 1. Check those out. Charts are there, and they say pictures worth 1,000 words. So guys, till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one left